Hi everyone, and welcome to this week's CyMax FinTech Market Insights. As usual, broken down into four pieces. First, part one, we look back at what happened last week, so the highlights from that. Then in part two, we're looking forward at the data that's coming out this coming week. After that, in part three is my macro outlook, and part four is just a lot of chart analysis on a variety of asset classes. So I hope you stay for all of them. So as usual, to start with the disclaimer, trading does involve the potential risk of loss of capital and is not suitable for everyone. Although, as I always say, hopefully it is for you. Now, many companies provide leverage, and just be aware you can lose substantially more than that initial investment. Views, opinions, everything included in these YouTubes are just purely just educational. We're just trying to help you. We're trying to prepare you for what's ahead and to understand what and why things are happening. And because of that, we're not trying to encourage you to trade or invest. That must be your decision. And of course, before you make that decision, consider the risks involved, your financial situation, definitely your level of experience and risk appetite. And of course, only risk capital you're prepared, but more importantly, that you can afford to lose. And again, if you can't afford it, then consider one of the trading challenges our partner offers, an absolutely great one. And if you've got any doubts, risks about the risk, etc., then just seek independent financial advice before you decide to risk that capital. It's everyone thinks that trading is so easy, but there's a lot of hard work and a lot of losses involved before it sort of all falls into place. So we're going to start by looking back at last week, and yeah, a very interesting week, wasn't it? It started so quiet with the US celebrating Independence Day on Tuesday, so it was a long weekend for many Americans. Obviously the volatility's there, lower volume, higher volatility. That's the way it works. And then, as expected, things livened up after the MOC minutes were released. But it was really Thursday's job data that caused the big moves. There was a lot of, and obviously that sort of carried on into Friday's NFP data as well, which was pretty mixed and probably a little bit of a surprise to many that it was lower. So the market sell-off on Thursday did give shorts that great opportunity to cover, but they had to be quick because the market didn't stay down there for long. And then of course we saw that bounce afterwards. So if we look at the data itself, PMI in the US was pretty much in line. Manufacturing is still low. It still seems to be the loser in sort of all of these sort of data that's coming out at the moment. Manufacturing was 46.3. ISM was down lower expected as well at 46, although services was higher at 53.9. And that's where you see the contrast. Manufacturing constantly under pressure and services highly in demand. Now with the FOMC, there wasn't really any big surprises coming out of that. The expectations are that there's two more hikes in the pipeline. One of them quite possibly coming in July, and the other one could be a little bit later. It seems that all the members did agree for the pause in June, but whether that's the sort of that's going to continue is doubtful, because when you listen to a lot of these central bank speakers, they've all got very mixed views and opinions on where they see the markets going, well, the economy going, and also where they see rates going. And then in the US, of course, ADP was more than double what was expected. It came in at 497,000. which again was a big surprise, and that's what really caught the markets out. But as I say, it did sort of provide shorts with a chance to cover if they were quick. Car sales increased in May. They was up to 15.6 million. JOLTS was down 9.8 million, so back under the 10 million again now. And of course then NFP came in at 209,000. The unemployment rate was unchanged at 3.6, so it's not too much of a thing there. But as I always point out, keep an eye on the hourly earnings and the weekly hours worked, and they were both up. So again, the unemployment numbers, I mean, with 3.6 unemployment rate, for me that doesn't really make much difference whether it's up a little bit or down a little bit. It's too low, to worry about it. But the earnings and hours worked are much more because they're inflationary data, and of course that's the key at the moment to the markets. And then moving on to the EU, retail sales, as expected, were down a little bit more than expected. They was down 2.9%. And then looking at PPI month on month, it was down 1.9%, year on year down 1.5%. Again, this just highlights to me, when you've got producer prices down, but you've still got CPI, consumer prices up, it's so clear and precise that, it's just corporate greed. And it's got to change, and as I always say, shop local, shop with your small retailers rather than these giants if you can. Okay, so and then in the EU, PMI came out that it was still weak, especially the manufacturing side is 43.4. And then moving on to Germany, PMI, the composite was 50.6, so it's still growth because it's above 50. Services 54.1. And again, sort of when you're getting this stronger data out above 50, it's still showing that there are signs of growth in the economy. It's just that manufacturing that's suffering. And then industrial production was also lower, as you would expect with manufacturing lower. Then moving on to the UK, PMI improved to 46.5. The composite was 52.8. Services 53.7. Construction was down to 48.9 though, and of course house prices down, and that's to be expected at the moment. Expectations, Bank of England's more rate hikes to come, inflation may be dropping but too slowly. It's just a matter of how far Bank of England's prepared to go with rates. Looking at China, the Caixin services came in at 53.9, so again fairly strong. PMI came in at 50.5, so still in growth territory, despite the fact that a lot of the other data is disappointing there. Australia, RBA left rates unchanged at 4.1, which was a little bit of surprise. Consensus was for another rate increase there. And then when we look at what's happening going into Japan, not too much there, just household spending came in, but again, it's down 4% year on year so far. And Canada employment data was higher than expected. So, it was a busy week, a quiet start, but definitely a busy grand finale. And whether these stock markets can maintain these levels, on one side you've got to say demand's dropping, but on the other side you've got to say with that corporate greed there, those profit margins are being extended as far as they can manage to get them. So a reminder of what we provide as a company. So obviously we provide these YouTubes to help you prepare for the week ahead. And then on top of that, we've got our daily newsletter that's just full of great stuff. It's global news headlines, then the full articles around them, and my views are in there as well on a daily basis. And then on a subscription basis, anyone that's interested in chart levels, including fresh pivot points each day, that's a service that is available. Now, when it comes to our amazing courses, we offer one-day workshops, and they're just sort of, for some, just to find out if trading could be for them. It depends if you want to turn it into a career or just have it as a secondary income. And then the other workshops just really help with any gaps that you've got already in your trading skills or your market understanding, of course. And then there's our 1 week course. By the end of 1 week, you're going to feel confident, competent. You'll have the real solid foundations on which to start to build your trading career. And in a week, if you've got an inner trader, I will find it for you. Then if you're really serious about turning trading into your career, then our accredited comprehensive masterclass is probably the one for you. We also do it as a flexi masterclass. There's not much difference. It depends if you want the accreditation or not. You want that diploma on your wall. Of course, at the end of the day, it's about making the money. But they're both designed to provide you with the knowledge, the fundamental knowledge and the trading tools to navigate just any market and in any market conditions, and of course, more importantly, any asset class. And of course, that's one of the benefits when I've got 50 years experience in the markets, that I've traded everything. And then for some, they don't actually want to go through courses, but they need a little bit of help from time to time, and that's where our trader mentoring comes in. We also consult to companies, helping them with their FX and commodity exposure, which obviously has been invaluable over the last 2-3 years, considering the way the markets have been. And of course, we provide trader education in all different forms, and to individuals, exchanges and brokers. Now, if you want to get into trading but you feel that you haven't got the funds to do that, you haven't got the capital, or you don't want to even risk your capital, then you can try through our partner. There's a link there. Go on and have a look at their details. They're definitely one of the, if not the best on the market for doing these challenges. And at the end of it, if you can qualify by passing their challenge, you will get a funded account. Any questions whatsoever, you can reach us at info@cymaxfintech.com, or if there's anything you'd like to ask me, it's chris.tubby@cymax-int.com. Okay, so hope to see you in part 2.